So today I wanted to do some stock analysis on Netflix and Comfort Systems. I think not only are these both quality companies, but they have a path to a lot of growth in the coming years. I probably don't even have to introduce Netflix, which I think helps support my thesis. But at its core, Netflix is an entertainment company that specializes in the streaming of movies and television. I think Netflix has a very strong moat. At the absolute base, just think about the space that they're in. Entertainment. Who doesn't want to be entertained? We've been entertaining ourselves since the dawn of time. Music, gladiatorial matches, plays, things like that. People need entertainment. So now that we've established they're in a field that has a lot of demand, quite literally the entire population, I'd argue, but they also were the first to do what they do, which not only means that they have most likely the most connections, but it's become ingrained in our society. I mean, there are literally slang terms that incorporate the name Netflix. They have all their Netflix originals, especially within the true crime and comedy niches. They have a chokehold on those, and people are eating it up. They love it. So now that we've established Netflix is in a good niche and people love it, let's actually look at some numbers and financials. Now, let me just say, I'm primarily a dividend growth investor, and Netflix doesn't even pay a dividend, which is just how much conviction I have in this company, although I don't own any shares of it. If we take a look at their chart, since 2002, they're up over 100,000%. I have literally never seen growth like that in my entire life. But if we look at their free cash flow per share over the past 5 years doesn't look too pretty. In 2021, they were getting really beat up. But since then, it's pretty much only gone up. And from 2022 to 2023, as you can see, it's skyrocketed from $3 a share to $15. But since December 2023, as you can see, we've seen pretty consistent growth up. And if we look at their free cash flow, their levered and unlevered free cash flow, it's kind of the same story. It's just been a steady, consistent line going up. Moving over to Webull, if we look at their net income, we can see that in the most recent quarter, it was up 23.9% year over year. And if we switch over to the annual chart, we can see they've had pretty consistent growth to the upside in their net income. Same thing with revenue, steady, consistent growth up. Operating income, same thing, steady, consistent growth up. If we take a look at their CFO, which is just the money they make from their core business, it's up 26% year over year in the most recent quarter. And if we look at it from an annual chart, yes, it does look pretty bad. In 2021 and 2022, it got really beaten down. But in 2023, that's when they actually started really cracking down on the whole password sharing situation. And since then, not only because of that, but because of price increases, they've kind of set a new baseline. And that $7 billion mark that you see is their new baseline. I'm not too familiar with Webull on the computer, and we can't leave out this lovely Call of Duty gameplay. So I'm going to do the last bit of this on my phone. Their total long-term debt is $14 billion. I'm not too worried about it. They're sitting on $8 billion of cash just right now, and they paid back $800 million in the most recent quarter. Now again, this company doesn't pay a dividend, but they aren't scared to do stock buybacks, so you do get a non-cash dividend. Recently, they've been buying back stock like crazy. In 2023 and 2024, they bought back $5 billion worth of stock. That's already an insane amount. But just in the most recent quarter, in Q1 2025 alone, they bought back $3 billion worth of stock. Moving away from this, one thing that I did want to talk about is by 2030, they aim to hit $1 trillion market cap, which is literally double where we're at right now. But they aim to do this by doubling their revenue and tripling their operating income. I've looked around and a lot of people agree that this might be kind of aggressive, but it's doable. And if you think about it from that perspective, you could buy right now at all-time highs and still double your money in 5 years. Now, I didn't run any valuation models on my own because, I'll be honest, I'm kind of lazy and I need to save some room for content in the future. But their forward and trailing PE is currently higher than their 5-year average, and I got ChatGPT to help me do a reverse discounted cash flow model, and right now the market's pricing in like 20+% price growth. So just taking both of those things into account, we're most likely overvalued right now, aside from the fact that we're at all-time highs. So just to summarize, they're in a good niche, their financials are strong and have been growing. They're also a subscription-based company, so that means steady, consistent revenue. They've already well outperformed the market, but they have a plan to continue that growth well into 2030. Overall, I think this is a very good quality company, and even though I'm a dividend growth investor, I would trust my money with Netflix. The next company is Comfort Systems, ticker symbol FIX. Now this one's a little more niche than Netflix, but they basically do HVAC, electrical, and plumbing services for a range of customers, and they pay and grow dividends. But HVAC is what I want to hone in on, and that's what I think will really give them a competitive advantage and be a catalyst for their growth within these next few years. So for starters, you can talk to anyone that has AC, and I'm sure most of them would agree with you that once you have it, you don't want to go back. But that's not even what I want to talk about. What I want to talk about is data centers. Now, if you don't know, data centers are basically big warehouses full of technology that make other technology work. And if you've ever played video games on like a PC or a console or anything for a while, you'll know if you put your hand on it, it'll probably be pretty hot. And that's basically what data centers are, just on a big industrial scale. They get ridiculously hot, and HVAC is literally a requirement for it to run. And AI is only making that skyrocket. AI takes way more energy than anything else before it and produces way more heat than anything else before it. And according to an article from the Yale School of Environment, the total electricity demand from data centers is projected to hit 1,000 terawatt hours a year by 2026, which is comparable to a mid-sized country like Japan. AI growth is expected to continue dramatically. I've seen a lot of people saying a CAGR of like 30% through 2030, which is ridiculous. But all that to say, Comfort Systems almost has the growth potential of a technology company while not even being in that sector and having other sources of income as well. What adds to their moat is they're considered a serial acquirer. Basically, they spend like 75% of their cash on buying mature businesses. And the reason for this, as So Mally 3 points out on Reddit, is because their industry, their niche, is dominated by a bunch of small competitors, often operating at the zip code level. And he gives an example of a small town grocery store in Oklahoma that needs a new AC system is going to call up the same HVAC contractor they've known for 30 years. But if Comfort Systems buys that company, then they've now broken into that small town in Oklahoma and further spreading their reach. And again, Somali 3 highlights this isn't in a predatory manner like big businesses do when they buy companies just to run them into the ground or completely change everything or whatever. Comfort Systems acquires companies and literally just keeps everything going the exact same way it was before, except now they have access to even more resources so they can do the job more efficiently. And that's basically why they've been able to perform so well over the past 30 years. But let's switch over to Seeking Alpha to look at some of these numbers. Their stock price has increased over 3,000% since 1997, so well outperforming the market. But if we take a look at some of their financials, their free cash flow has been growing fairly consistently. It did take a dip in 2021, and trailing 12 months, it has dipped again. But overall, over the past 5 years, it's been a fairly consistent move up. If we check out their dividends, they've been paying dividends for 19 years and growing dividends for 12 years. That's what we like to see, consistent history of dividends. If we look at their dividend safety, I can't see their cash flow payout ratio, but as you can see, their dividend payout ratio is somewhere around 9%. But dividend growth is what blows me away. Look at these CAGRs. Three-year CAGR of 42%, 10-year CAGR of 20%, 5-year CAGR of 29%. Overall, just absolutely amazing dividend growth by this company. And if we look, their dividend yield is about 0.35%. But if we switch over to Webull, we can see their net income has been growing. It's up 75% year over year in the most recent quarter. Amazing net income growth. If we go over to the annual chart, kind of like Netflix, it's consistent growth to the upside. And same thing with their revenue. Consistent growth to the upside. Operating income, same thing. Consistent growth to the upside. That's what we like to see. It kind of gets tedious, annoying, repetitive, whatever you want to say. But if we go to their CFO, that's where it starts to take a turn. Now, it was negative in the most recent quarter, but I briefly looked into this, and a large part of it was because of deferred tax payments from 2024's hurricane and acquisition earnout payments. But if we go to the annual chart, it's the same thing, consistent growth. Now I want to jump back to my phone because again, you know, Call of Duty gameplay, and I don't really know how to use Weevil on the computer. But their total long-term debt is $63 million. And right now they're sitting on $204 million. So they just have way more cash than the debt. Their debt literally doesn't even matter at all. But aside from that, and aside from the fact that their dividend growth is some of the best that I've ever seen, they also buy back stock. In the most recent quarter, they bought back $90 million worth of stock. And if we look at the annual chart, they've been pretty consistent about buying 20 to 30 million dollars worth of stock over the past 4 or 5 years. But I also had ChatGPT run a reverse DCF model on comfort systems as well. And right now, according to its calculations, the market is pricing in a mid-single digit free cash flow growth around 8%. But if we're expecting closer to 15 to 20%, which so far has been kind of the average, but especially with the whole AI growth that I was talking about, we could potentially see a much higher price target from anywhere from like 600 to 800 bucks. So this might be a pretty reasonable price, even though it's kind of approaching all-time highs again. So just a quick summary, and I'm going to group Comfort Systems summary in here as well. Both of these companies have well outperformed the market. Both of these companies are making money. They've seen consistent revenue and net income growth. Both of these companies have some type of growth catalyst or plan to move forward. Netflix is trying to hit $1 trillion market cap, and FIX is just going to grow by proxy with this AI boom that we're going to have. Overall, I think both of these companies are good at what they do, and especially with me being a dividend growth investor and FIX being a dividend growth company, I have even more of a reason to buy it. I hope you got something out of this video. If you did, maybe consider leaving a like, comment, subscribe, whatever you want to do. If you want to tell me the video sucks, if you want to throw me some stocks to check out, I'd be down for either of those as well. Anyways, you know, I don't own any shares of Netflix, but I do own some comfort systems. I actually bought some during the dip, and I'm up like 33% right now. Pretty hyped on that. But I appreciate you for watching. Good luck on your investing journey. Also, before this ends, let me just say, this was a terrible match for me, but I did manage to get some kills before the game ended, I promise you. But oh my gosh, I still have 0